Welcome to today's Explainer. We're diving into a concept that seems super simple on the surface, but honestly, it's usually the invisible dividing line between folks who build lasting wealth and those stuck on a never-ending treadmill of bills. We're talking about the illusion of ownership, and specifically, assets versus liabilities. So let's break down what true wealth actually looks like compared to the mirage we're basically sold every single day.
Let me start by asking you a really direct question. Is your expensive car actually an asset? I mean, think about it. When you park a brand new vehicle in your driveway, knowing full well it loses up to 20% of its value the absolute second its tires hit the street, does that really signify financial success? We're kind of taught that the ultimate finish line is just acquiring these big-ticket items, but equating a massive price tag with actually building wealth, that's a critical error.
Because here's the harsh reality. Many purchases that appear to increase your wealth, they actually reduce it. This is just a massive, massive pitfall. It's this incredibly common belief that everything you buy magically adds to your personal balance sheet. Actually, scratch that. It's more like a trap. Believing that acquiring expensive things equals acquiring wealth literally traps your hard-earned capital in items that actively work against your financial independence.
So let's look at the true definition of an asset. Basically, it's something with the potential to increase in value or generate income over time. I want you to notice the action words there: increase and generate. Whether it's a rental property collecting monthly checks or, say, a dividend stock that's automatically reinvesting, an asset isn't just some static object. It's like a tiny little engine that goes to work while you sleep, continuously pushing money back into your life. How great is that? Now, on the complete opposite side of the spectrum is the liability. This is something that costs you money to own and, more often than not, loses value over time. If an asset is an engine generating wealth, well, a liability is a leak draining it. The longer you own it, the more it demands from your wallet while simultaneously becoming less and less valuable to anyone else. And ironically, right, these are usually the exact things we work so incredibly hard to buy.
It really all boils down to one simple, absolutely crucial filter. Assets put money in your pocket. Liabilities take money out of your pocket. That's it. So before you swipe a card or sign a loan, just pause and ask yourself, which category this falls into? Will this quietly deposit funds into your life, or is it going to demand a piece of your future paychecks just to stick around?
And this brings us right to what we call the luxury trap. People constantly mistake expensive cars, luxury gadgets, and oversized homes for assets simply because of their massive price tags. Now look, there is absolutely nothing wrong with enjoying nice things or, paying for convenience. We all do it. The fatal flaw here is mathematically categorizing them as assets on your balance sheet. Why? Because they rely entirely on your continued daily labor just to sustain them.
Plus, these quote-unquote fake assets come with some serious hidden costs. The initial sticker price, that's really just the entry fee. The true cost of ownership is a relentless, ongoing stack of expenses. We're talking specialized maintenance, property taxes, way higher insurance premiums, and of course, depreciation, which is pretty much a silent killer wiping out your resale value day by day. You aren't just losing your initial capital, you are actively committing your future income to maintain an object that's dropping in value.
We fall into this trap because massive invisible forces like aggressive marketing and serious social pressure push us toward buying impressive-looking items rather than building actual income-producing assets. We are completely conditioned to associate visible expense with success. But building true wealth, it requires ignoring that noise. It means quietly accumulating assets that actually build your net worth, even if they don't look particularly glamorous on a social media feed.
So how do genuinely wealthy individuals navigate all this? Well, they use a totally repeatable framework. Step 1. Before making a purchase, they stop and evaluate if it grows their net worth or creates future cash flow. Step 2. They ruthlessly prioritize investing in assets first. And step 3, this is really the key to having it all, they delay luxury purchases until those newly acquired assets generate reliable passive income to actually pay for them. They literally use the cash flow from the assets to fund all the fun stuff.
This all leads to an incredibly powerful realization. The price of an item doesn't determine whether it's an asset. Just let that sink in for a second. $1 million sports car sitting in a garage, that is a massive liability. But a $100 share in a highly profitable business, that's an asset. The price tag is totally irrelevant. What truly matters at the end of the day is whether that item adds to your long-term wealth or if it drains it.
Which leaves us with a vital question for you. What will your next purchase be, an asset or a liability?
Every single time you earn $1, you're standing at a crossroads. You can buy an impressive-looking anchor that just drags down your cash flow, or you can buy a tiny piece of an engine that pushes you toward actual financial freedom. The illusion of ownership is super powerful, but hey, now you have the framework to see right through it. So where is your next dollar going to go?